Today, we sit down with Sharon Karaffa, who understands the capital markets and multifamily lending space better than most. She's got 20 years of experience working with investors like you to secure the right loan products for your multifamily investments. And today, we talk about the landscape with Fannie and Freddie, some of the challenges that investors are facing, and how to position yourself for success in today's market. If you want to learn how to grow and scale using the right lender for your deals, check out our conversation right here on Multifamily Insights. Now, Sharon Karaffa is the president of Multifamily Debt and Structured Finance for Newmark's Multifamily Capital Markets Division. Now, Sharon's expertise centers on agency lending, capital market strategy, and providing advisory services rather than traditional investing techniques. Let's welcome to the show, Sharon Karaffa.
Thank you. Thank you so much for having me, John. I'm looking forward to our conversation today.
Yeah, absolutely. Sharon, it's great to have you on. I went over your background at a very, very high level. Why don't you take 2 minutes and fill in some of those gaps?
Sure. Um, so I started my career in corporate finance. I got a finance degree from Penn State and then worked in a couple of different places, all sort of in a corporate finance planning forecasting type capacity. I found myself at Fannie Mae in 2003 and 2004, working in the financial planning and forecasting group. At that time, uh, Fannie Mae was going through a restatement, and everyone between me and the CEO was displaced or let go. And I was asked to take on a very large role for someone in their mid 20s. And went ahead and did that. Luckily, the CFO who I was reporting to had an amazing chief of staff who took me under his wing, kind of became my mentor, stayed with me as my mentor. And then when we got through the restatement, they said, "All right, Sharon, we're going to ask you to leave the corporate finance side of the business and move into the forward facing, client facing business. And so, what do you want to do? Do you want to be in single family? Do you want to be in multifamily? Or do you want to be in capital markets?" And I said, "I really don't know anything about multifamily. Let's try that. I'll try to learn something new." So I moved over to multifamily, and that's what I've been doing for 20 years. So I kind of fell into it. I know people now go to school for it and they get degrees in real estate and they come out, and have that as a focus, but I definitely fell into it. I spent several years at Fannie Mae managing lenders and managing borrowers and working on credit facilities, which is sort of a large portfolio financing executions. And after doing that for a few years, decided that I'd try something new and move over to the lending side. So in 2017, I hopped over to Newmark. At that point, it was Berkeley Point Capital, and we were being acquired by Newmark, and Newmark was going public. So I joined in the summer of 2017, and in the fall, Newmark went public with the Berkeley Point Capital platform, which was the multifamily debt platform, combined with ARA platform, which was the multifamily investment sales platform, and then some other financial services, real estate services, brokerage and leasing and title and valuation that was kind of under the Cantor Fitzgerald family. Pulled all those together and went public in November of 2017. And it's been a fun ride working in multifamily between investment sales and the debt side since then.
I love it. What a great background, right? You talked about, really coming up in finance, getting a degree from Penn State, working with Fannie Mae, and went through that restatement. Coming out of that is when you really focused on multifamily, and you've really been in that space for the last 20 years. Now with Newmark kind of leading up a lot in the multifamily space between capital markets, debt structure, and things like that. The restatement, I've never heard that term. So what does that mean?
Yeah. So Fannie Mae at that time had to restate their financials. And so that was sort of like an auditing issue
Got
and
it.
Freddie Mac at that time had to do something similar as well. So it was really more of a restating their financials. And so that took a year and a lot of brain power kind of thrown into the mix to restate all of the financials. So that was not necessarily multifamily or single family or capital market specific. It was just more corporate. Fannie Mae
Yeah.
needed to restate their earnings. Yeah.
And it sounds like that experience though opened up the doors, especially from your leadership, to see kind of the value you brought to the table to say, hey, what do you want to do next? Like, what was it about that process that really allowed you to shine or kind of really learn and grow and kind of impress your peers and kind of your leadership team?
So I really have to say having a mentor and he was a mentor, but also a sponsor, someone who really took me under his wing and really helped me. I mean, I think I was 27 and I was reporting to the CFO of a huge company. And he really helped me along in that process and mentored me throughout the way. So I think having sponsors, people who are willing to put their political capital at risk for you, and people who are willing to invest in you and help you see the next thing, is so critically important as you're growing your career. Also, I wasn't afraid to make some lateral moves. So I've enjoyed multifamily and real estate because every couple of years I've sort of switched my job around a little bit. So I was, working with one set of lenders and then working with a set of borrowers and then running a strategy on IT and then running a strategy on executions. And so every couple of years being able to expand my skill set and work in different areas was not only really interesting to me, but also helped me grow the skills needed to be able to be a leader. And so my mentor and my sponsor from my very early days at Fannie Mae, and they stuck with me throughout, really helped me navigate all of that.
I love it, right? We talk a lot about mentorship when it comes to investing, and it just goes back to show like no matter what you're doing, it's so helpful to have mentors and sponsors, people who can guide you along the path because they have that experience. And we get into other worlds, and for some reason, people feel like they've got to make it on their own, or they got to just learn in a box and just watch YouTube videos or even podcasts like this. But the reality is, there are people who understand what it takes to be successful, and if you can find those people, they can champion you, they can guide you through the process, and it makes it's so much easier to find success. I mean, you still got to do the work, but having people who can guide you on that journey, it's so critical. And that's why you're so big on mentorship for sponsorship and finding people who can help you find that success. You ended up spending most of your career in multifamily, and you've seen the landscape change a lot, right? I mean, you talk about the last 20 years. I mean, that goes back to the last recession, that goes to, 2016, 17, 18, COVID. Like, obviously, a lot has transitioned. Can you talk from the lender's perspective? Like, how do these ebbs and flows change your perspective when you're on the other side of these multifamily transactions?
Sure. Um, yeah, I mean, when I think about the last 20 years, obviously the largest impact that we've seen in my space. And so I talked about Fannie Mae, but we're Fannie Mae and a Freddie Mac and an FHA lender. So we do about 40% of our multifamily originations are Fannie Mae and Freddie Mac, and 60% the rest is a mix of debt funds and life companies and banks, et cetera. The agency landscape has changed considerably in the last 20 years. So in 2008, during that crisis, uh, the agencies were put into conservatorship. And so they became regulated by FHFA, the Federal Housing Finance Administration, and have been since 2008. So that was really a big shift at that time. The agencies at that time were borrowing from Treasury to cover losses. They borrowed from 2008, I think, to 2012, which is when they became profitable again, 150 to 190 billion from Treasury. And then in 2009, they became profitable again. I'm sorry, in 2012, they became profitable again. And between 2012 and 2019, all of their capital was swept. And so the money that was swept didn't necessarily go to pay down the debt, but it went to the Treasury. And so the Treasury swept during that time period 300 billion. So they didn't pay down the debt necessarily, but they paid back all that was borrowed and then some. And so in 2019, they were able to start retaining capital again and start building their capital base. So for the last 17 years, and it was never intended that the agencies would be in conservatorship for 17 years, but for the last 17 years, there's been constant discussion and conversation about how do we exit conservatorship. And that's done is created some uncertainty in the market for investors and for lenders and for borrowers. But overall, since it's been going on for 17 years, I think the market has sort of, gotten used to the reality as it stands today and sort of accepted it. Now we're in a position where, and with every change in administration, the administration talks about housing reform and how to exit conservatorship. And so we're in that situation again today, where the administration is talking about exiting conservatorship. And so they've got a few different plans outlined. I think we'll see it happen. We haven't yet seen the agencies build up enough capital. They haven't hit the regulatory capital requirements that are set for them. We expect that they will in the next couple of years, but there's been a handful of ideas thrown out about exiting conservatorship and privatizing the agency. So that's sort of been like the discussion throughout my career in housing, uh, particularly as a Fannie Mae and Freddie Mac lender. Fast forward through COVID, now the discussion is interest rates, and so interest rates have been very volatile since COVID, and we really needed the volatility to sort of settle. It was okay if rates ended up higher, in my opinion. Right? We had historically low rates for years, and so now if we're resetting at a higher rate environment, I think investors can withstand that if we don't have a tremendous amount of volatility. So we had higher rates and then we had volatility, and now I think we're starting to see things calm down a little bit, and we're starting to see transaction volume increase. Our investment sales platform is seeing significant increase year over year. Our debt platform has also seen more about a third, 35-ish% higher year over year than we were last year. So we're starting to see transaction volume come back, which is incredibly positive and way more fun.
Yeah, it's so intriguing, right? You read headlines about the privatization of Fannie and Freddie, but sometimes you don't understand the full history of how we got there. And I don't know if everyone really understood, like, hey, it's still under this kind of conservatorship where all the money they're making is getting swept up and taken to the treasury. And that starts to maybe shine a little bit more light on why the conversations are happening or what needs to happen to make that transition. You talked about the interest rate volatility, which our listeners are very well aware of. I think one of the things that investors always struggle with is really understanding, well, what does this mean for me and my investing strategy moving forward? For a while there, over the last couple of years, there was a saying amongst many investors, particularly when I went to events, and they would say, "Extend and pretend." Right?
Mm.
Survive till 25. So you would hear these sayings, and it feels like it really just continues to be a situation where investors are kicking the can down the road and waiting and praying, right? It's this hope strategy that, hey, rates may come down or rates will come down, and then we will be able to either refinance or sell and, salvage these deals. And I'm particularly talking about deals that were made under bridge or temporary terms. I think the stuff that's locked in the agency debt is probably not really as exposed as the stuff under bridge. Can you just talk about that dynamic and how you all look at that as a lender between where things are today, the amount of loans that are coming due here over the next 12 to 18 months, and how do how do you foresee this playing out at a macro level?
Yeah, I mean, I agree with everything you shared. I think you're right. The deals that are sitting on agency balance sheets or securitized by the agencies, deals that are with life companies, we're not really going to see very much distress there. The debt fund and bridge loans that were originated during a very specific period of time where maybe there aren't any more extensions left, and it was originated. We haven't seen the NOI improvement in those properties. Those are where we might start to see some distress and perhaps some CMBS deals that were underwritten very aggressively. So we may start to see some distress in those spaces. My personal feeling is we're not going to see the amount of distress that everyone was sort of waiting for over the last few years. I think the supply waves that came across the Sun Belt and across the country has mainly been absorbed. We've seen a really great absorption and all of that new supply. We haven't yet started to see rent growth really tick up, but I think it's a matter of time. And so as those units are continue to be absorbed and we've seen slower construction and new product starts, we're going to start to see the supply demand equilibrium happen a little bit and start to see a little more NOI growth. I don't think that, and maybe I'm an optimist, but I don't think that the extend and pretend thing was real. I think that there were extensions, and through those extensions, it's given properties time to improve operations so that we can exit out in a positive way. I think we're going to see a lot of that, and less distress than people might fear.
Sharon, I appreciate that last comment you made when you talk about extend and pretend and really the nuance of there's a difference between extending and truly pretending because you don't have another option versus extending and giving yourself more time to improve the property's operations. There's so much focus on interest rates and rightfully so. But on the same note, real estate investing, particularly commercial real estate investing, it still comes down to the basic principles of NOI, right? NOI determines value, NOI and cap rate. We know demand has softened, so those cap rates maybe are expanding, but you can still control the NOI to an extent. And if there are ways to increase the value, to drive up the income, to decrease the expenses, that is something that we can do. We cannot control interest rates. So, it's almost wasted breath sitting there having too long conversations about it because there's not much you can do, but you can control kind of the property's performance. And I think what a lot of operators lose sight of is paying attention to what they can control, the occupancy, the rent growth, managing concessions, looking at those expenses and figuring out where you can tighten things up. That's where you win as an operator and as an investor. And right before you and I jump on, I was actually talking to one of my investors who is invested in multiple deals, not just mine, but many of those deals are struggling. And this is a conversation we had where, there was a capital call and he ended up, doing the capital call and that's not, panning out for him. So he's a little frustrated that, hey, I did this other deal with this other operator. They did a capital call. I did it because I didn't want to dilute my interest. And I thought that was going to turn this deal around, but that's not really panning out. And the nuance in that is you have to understand what's happening with the deal. How are those funds going to be used? Is it going to improve the operations? Is it going to drive NOI growth? Or is it just simply more funds to cover kind of the mortgage? And this is where things kind of get a little tricky and it's obviously on a case by case basis. But I imagine that there was a period of the last, 5 years where things were booming. And over the last couple of years, things have really tightened up. As a lender, do you all change kind of your criteria at that point? Do you just get more restrictive on what you will allow? Like, how do you all change your perspective on the lending environment as you start to see some of these things pop up?
Sure. So, I mean, I don't think we just like pull back across the board. We're going to look very specifically at the property, the market, the borrower, and adjust based on what we see. Sorry, let me stop a minute.
Yeah.
Um, yeah. I'm not sure I have a whole lot more on that one. I mean, your question is really how do we change
Yeah.
our
Let me
lending
ask you again. Let
standards?
me ask
Yeah.
you again.
Yeah.
So when you see the market changing and you see, now investors are starting to struggle and from our standpoint as investors, at least from my standpoint, I know I just start to see it on the acquisition side when we're having conversations and the terms start to look a little bit different, right? And I'm having conversations with other investors and they're like, hey, I'm, struggling with this. So we start to get that feedback in the marketplace. But what does that look like on your end? Like, do you all sit and have certain metrics where, was it delinquency? And once delinquency gets to a certain level or the DSCR numbers get to a certain level where you just stop and say, hey, we're no longer lending with this criteria. We're not using this criteria. Like, what does that look like on your end?
Sure. So, there's not a hard and fast rule, I would say, across the board. It's really a relationship business. And so we're going to look very closely at the borrower. We're going to look closely at the property and the market and all that's happening in the market, the fundamentals of the property to really determine the right loan amount and the right terms for that client. So I would say we don't have a hard and fast rule. We don't. Also, as a Fannie Mae and Freddie Mac lender, we are in every market every day. So the purpose of that program is to provide liquidity in all market cycles. So we're going to be there for you and try our best to help. So we're also seeing a tremendous amount of liquidity in the market between agencies, between debt funds, banks are coming back. So I think there's deals to be had. We are advising our clients at this point to not wait for that thing that they expect to come, which is like the best rate again, right? So if you have a capital event coming and you need to make something happen, if it works today, let's execute today, right? Versus waiting for the rates to come down because that's again out of our control, as you mentioned.
Yeah, I think it's important to understand, right? Because it's a living, breathing thing, and it always is adjusting. And it's one of the things that I hear from investors is they want to wait on the sidelines and maybe have some dry powder and kind of wait to see. And I get it strategically. I get it on paper, right? It makes sense. I think for most people, though, if investing is helping you achieve some of the goals that you have, I think you have to have a different approach. And part of it is you have to know what's happening in the market. And you only know that if you're actively participating on a day-to-day, week-to-week basis because things do change. And I mean, when I first started investing, I could almost pinpoint the day. I bought my first property in 2012, and I remember December 2011, I made a list of properties that I was looking at and kind of interested in. January, I started to actually look at them. In February, that second week of February, some of those properties started to go under contract. And I was like, oh, well, that's interesting. For the last 2 months, nothing. And now all of a sudden, stuff's going under contract. So I updated my list. The next week, three more went under contract. I said, huh. And, the same thing happened. I saw a property I really, really liked. I made my agent take me out there. The quickest he could get an appointment was that Saturday, which was like 2 days later. And I kid you not, I got there Saturday morning, 10 a.m. I saw somebody walk out the house in front of me and they had papers in their hands. And I'm like, I know this person didn't get this thing under contract. Not just, I was supposed to be the first appointment. Somebody beat me. And sure enough, this person signed a contract on site right before me. And it's like, okay, this market has gotten hot. If I find something, I've got to move very fast to get it. And we did locking up a property within the next 2 weeks. But that's because I was actively looking. I was a newbie at that point. But, I say that because I know a lot of people just they're waiting on a signal. They're waiting on a report. They're waiting to see the Q3, data. And you can't wait. By the time you see the Q3 data, it's too late. Like we're already actively in Q4. Like you want to be a part of, making it and seeing it in real time and not waiting for the data. Obviously, you all rely a lot on reports, data, and information. How do you balance kind of, living in the day to day with speed while still kind of making sure you're analyzing what's happening at the macro level and in the micro markets so that you are making informed decisions?
Yeah, that's a great question. You can't get reports are definitely rear view mirror, right? So by the time you synthesize the data, you pull it, you scrub it, you analyze it, it's in the past. So it's good. It's helpful to understand, and we can watch trends and maybe make some predictions based on the trends that we see. But you are right. You need to be in the market. And we've talked about it a little bit, but this is a relationship business. And if you know you want to be in Charlotte, you know you want to be buying in Charlotte, you should be making deep relationships with brokers in Charlotte. That's just the way that it's going to have to work, right? So that you're staying front and center, and you need to be cultivating those relationships and building that network in the markets that you want to be in so that you can get that real time information, because there's not really a way to synthesize what's happening on the ground today into a report that gets out to investors that day. So you do need to have those relationships. And I think even on the lending side, it's the lenders are going to look to how you've behaved in the past and how you've come to the table. And that matters and that counts. So building those relationships with lenders, with brokers, is really important.
Sharon, what's a common mistake you see investors make when they're approaching you and your team and trying to get financing or structured debt for a deal? What's a common mistake you see?
So one thing that speeds the process along is to have all of your information ready. So if you don't have all your information ready and you need to move fast, there you could be beat, right? Somebody could come in with all their information ready and move along. Kind of like the example that you shared. If you had walked into that property with everything ready to sign, maybe you'd have a leg up. So I think, understanding your organizational structure, having all of your financials, understanding the property, having all of the history on the property, all of that information ready to go so that we can just hit the ground running, can help move the needle.
What's the best way to gather that information or identify what information is needed?
So I think I would talk to a loan officer. I would talk to a broker or a debt originator who can help, because it's going to be, depending on if you're looking for a bank loan or a life company loan or an agency loan, perhaps it's slightly different. But I would absolutely build those relationships. Talk to your loan officer about how to position yourself best. And if you're looking at acquisitions, talk to a loan officer at a shop that brokers sales, right? So at Newmark, we do both. We broker the buying and selling of properties and also loan origination. So talk to someone at like a Newmark who can help make sure that you're seeing the properties in the markets that you want to see and that you are all teed up to go ahead and move forward as soon as you find what you like.
Yeah, we started talking about mentorship and sponsorship, and I think it's so important to build relationships. And what you're getting at here is you got to build out your team. Yes, there's the lender side of it, but if you're working with an agency like Newmark, where they have the brokerage component too, like they can help you in a lot of ways because they may have access to deals that aren't really listed yet, but maybe there's some introductions if they understand what you're looking for. You built those relationships. So this is a great time to really strengthen those relationships, get to know people, especially in your markets, right? Get to know the brokers, get to know the lenders, get to know the individuals, because that's going to make you more viable when you do come across opportunities that you're looking to get in front of and you're looking to take down. The one thing I want to ask you before we transition to a round of insights is we've seen technology start to, come into the landscape and develop. You've been around for a long time, so I'm sure you've seen, the implementation of a lot of different things. But in today's world with AI and technology really starting to take hold, how do you see that changing the lending landscape?
So we are going deep in AI right now and trying to really understand how it can help us and our clients. Um, I think there's still a lot that needs to be done. The learning machines or mechanisms are only as good as the data that's there and the repetition of the data that's there. So we're working really hard. In fact, we have a Newmark GPT that we use internally, sort of like a chat GPT, but for Newmark, and we're trying as hard as we can to make it really smart and feed it information and iterate on it so that it can be helpful and not only helping us underwrite deals and do what we need to do for our clients faster, but also perhaps offer some predictive analytics that we can share with our clients as well. So I think it's coming. We had thought earlier this year that like it's here and let's get ready and let's roll it out. I think there's still some work that needs to happen in AI to really be providing that value. So I think it's coming. It'll be here, but it's not quite here right now.
I love it. Great stuff. Sharon, what is the best way for our listeners to get in touch with you?
You can call me or email me, and I'll make sure you have my contact information.
Sounds good. We'll put all that in our show notes. Well, right now we're going to transition and go to our round of insights. When you think you found a great deal, asking the right questions could be the difference in finding a stud or a dud. Listen, we've put together a new guide to help you out. It's called 7 Questions You Must Ask Before Investing in Apartments. Now, in this guide, you're going to learn how to uncover red flags, quickly identify underwriting risk, vet sponsors and team members, and confirm key assumptions. Now, this is a guide that's going to help you be a better investor, whether you're an active investor or you're a passive investor looking to partner with other operators. Asking better questions is the key to identifying great opportunities. So download this free guide. Go to our website, casmoncapital.com/7 questions. That's the number 7 questions. And you can access this free guide today. To make it easy on you, though, we've put a link in our show notes. So you go to the show notes, you can click that link and access the guide right now. This guide's going to help you make better investment choices, asking the right questions to build your portfolio. So be sure to download it today. Sharon, give me a failure or an apparent failure that sets you up for later success.
Okay. So if we have a minute, I mentioned early in my career in planning and forecasting, there was a meeting on Monday mornings that happened with the CEO and the executives. And on Friday afternoon, we each took turns. Somebody was responsible for pulling information together and getting it to them on Monday morning. And so it was my turn. I stayed late Friday night. I put it all together. It was highly sensitive information, and we locked it in a cabinet in the cubicle above me. And I went home, and on Monday morning, I forgot that it was my job to get it to the CEO and the executive team. So I walk in like 15 minutes late with my coffee, strolling in, and I see my boss and my colleagues racing through the lobby with handfuls of materials, taking it to the CEO. And when I got up to my cube, they had to take like a hammer and like there were wood chips. They had to break through the cabinet to get the materials out. And I was pulled into my boss's office that day, and he said, "This cannot happen again." And I said, This is the dumbest thing we do. Why can't I just bring it Friday night? Like, I made a mistake. I get it. I made a huge mistake. It will never happen again. But can we change the process so this never happens again? So that kind of set me on this path of, first of all, I'm always prepared and I'm always thinking about ways to make it better, easier, switch the process around so that nobody has to worry all weekend about this 7 a.m. thing they have on Monday. Let's just do it Friday night. It's a simple fix. So that's one failure that almost cost me my job as an analyst that I think did shape the way that I approach decisions and process now.
I can visualize that experience, and I can imagine how scary that could be, but also just the lesson learned there. So I appreciate you sharing that. All right, give me a digital or mobile resource you recommend for our listeners.
Well, I mean, I think I think LinkedIn we use it all the time, and maybe that's a little generic for us internally. I'm loving Newmark GPT. I mentioned it, so we're loving that internally, so that we can build in and provide insights to our clients.
All right, give me the book you've recommended or gifted the most in the last year.
Okay. I love Mick Ebeling. Mick Ebeling is an entrepreneurial. He's a philanthropist. He's an inventor. We had him come speak at our housing client event earlier this year, and his story is inspirational and amazing. He's someone who sees like human suffering and thinks about, instead of saying, "Well, that was an impossible challenge to fix," he figures out ways to fix it. And he's invented amazing things to help people. And he's just an amazing person. His story is amazing. And his book is called Not Impossible.
I love it. Sounds like a great book. We'll have to check that
Yeah.
out. Give me a daily habit that helps you stay focused on your goals.
I use my calendar. I'm very big on my calendar. I've got to keep everything organized. If I don't, who knows where I'll be. But so I manage my time pretty specifically. I've got 2 kids also. So I've got work obligations and home obligations, and it's all in the calendar, and I use it religiously.
There you go. Give me your number one insight for. You know what? I'm gonna say this a little different today. Give me your number one insight for selecting the right loan.
The right loan is one that helps you achieve your objective and your long-term strategy. And partnering with the right loan officer or loan originator who can help you see various executions and determine which one achieves your long-term goal. So back to relationships, and a trusted advisor in your loan origination team who can help you identify the loan that helps you achieve your long-term goals.
I love it. Great stuff there. All right. Where are you located?
Outside of DC in Northern Virginia.
All right, Northern Virginia. Give me your favorite place to grab a bite to eat.
Oh, I like the neighborhood spots. So I live in a town called Vienna, Virginia. It's walkable. There's a few, family-owned local places right around the corner from me. So I like the local restaurants right in my town in Vienna.
I love it. Sounds like a great spot. A couple great spots there. Really good information. A couple things stand out to me. One, just understanding. One, I love your background in finance, right? Just understanding the capital markets, the debt structure. You spent your career in this space, and you talked about mentorship and sponsorship. Just continue to be an educator, someone to learn, someone who's looking to grow. I think that's so important for all of us. And if you really want to grow and scale, part of it is you have to be a learner, right? A lifelong learner. The other thing that jumps out to me is just the team, putting the right people on your team, getting the right loan officer, the right person to guide you through that process, understanding what products exist, but also helping to understand your goals and objectives and building deep relationships. You talk a lot about kind of just where things sit from Fannie Mae, Freddie Mac, understanding the agencies and what's happening there, and the kind of things we need to be paying attention to as investors. But ultimately, that we always want to be looking at the marketplace. Yes, there's always some volatility, but understand what's happening, and you don't necessarily just want to wait, because if you wait because you're waiting on data or you're waiting on that signal that says, okay, now everything's cool, you can invest now. By the time you see that signal, it's probably going to be too late and the market's already going to be shifted. So just constantly be involved in the market, talk to the experts, build out your team, and that's going to set you up for success. You mentioned the best way to get in touch is really reaching out through Newmark. So if you send me the right email address or the right website, we'll put a link to that in our show notes for our listeners to be able to reach out. Sharon, thanks for being a great guest and coming on Multifamily Insights. We look forward to staying in touch with you, and I hope you have a great day.
Thank you. Thank you for having me.